Hello, everyone. This video is chapter 3, part 5 on accruals. So what I'd like to do is start out with a PowerPoint. So let me go ahead and screen share here. Okay, right away, I'd like you to write these down and memorize them, because these are the ones that you're going to see on homework, and they kind of don't change, right? So if you have this in your head, doing these entries will be easier. Okay, for accruals, when it comes to revenue, debit accounts receivable, credit service revenue, right? We'll be talking about this, but right now just write it down and memorize it. Another accrual for revenue is debit interest receivable, credit interest revenue. On the accrued expenses side, debit interest expense, credit interest payable. And finally, another accrued expense entry would be debit wage expense, credit wages payable. Okay. So now I'd like to talk to you about these. So this is what we're going to be doing here. Let me stop the share. Well, actually, we don't need to stop the share. We need to stop the PowerPoint, actually. And we're going to go ahead and show you this. Okay. Well, what are accrued revenues? Those are revenues that you've earned, but you haven't received any cash, right? So you've done these before, and I think in chapter 2, but we didn't call it accrual per se, but that's what it is. So adjusting entry would be you recognize the revenue, in this case, interest income, and then because you earned it, but you didn't receive it in cash, you do own the right to receive the money. So it's a receivable, right? So debit interest receivable for 1,000, let's say, and then credit interest income for 1,000. Again, accrued revenues. You've earned the revenues, but you haven't received the cash. So you own the right to receive it. So it's going to be some type of receivable. Under accrued expenses, those are expenses incurred, which means they happened, but you haven't paid them yet, right? You didn't pay cash. So a typical accrued expense that you incur, but you haven't paid yet, would be wages. Okay, so let's say that a few days at the end of the month, your employee works for you, so you incurred the wage expense, but you're not going to pay them to the next month. Well, you have to, show on the income statement the wage expense and the fact that you owe it. You haven't paid it. So you incurred the expense, but you haven't paid the cash. So you have to make it a payable. In this case, wages payable. Okay. Debit wages expense, 500. Credit wages payable, 500. That would be the two. It's rather accrued revenue or accrued expense. Let me give an example of accrued expense. Adjusting entries make sure that expenses are recorded in the period they happen. Okay, let's say that your employee works for you in December. Let's say it's just $100 a day. Let's say so. There's 3 days. So you would be incurring wage expense of 300. In January, they work for you for another 7 days. That's 700. So you record the wage expense in January, which would be 700. Now, because we have to prepare financial statements at the end of December, we need to accrue the wage expense. Why? Because it happened. It's got to get onto the income statement. So on December 31, we're going to debit wage expense, $300, because we incurred that expense in December. Now, like I was telling you, we haven't paid them yet in cash. So we owe the employees. So what we'll do is we'll credit wages payable. That's what happens in December. Now, let's say we move on to January, and again, our employees work for us, and we've incurred $700 worth. Now, it's interesting. At the end here, we're going to actually pay them, right? Payday. Here's our pay period. Part of it is in December. Part of it is in January. So we are going to pay them for the full $1,000. But what do we do in January? Well, first off, because we pay them in January, we're going to credit cash for $1,000 because that's payday. That's we actually paid the cash. Now, why are we paying $1,000? Well, in January, they work for us, right? Matter of fact, they worked $700 worth. So we're going to recognize wage expense of $700, of course, in January. Well, and then the thing is, we're paying them $1,000. Why? Because we got to pay what we owed from before, right? So we accrued the wage expense and we recorded the wages payable. But now in January, we're going to pay them off. So that $1,000 goes toward the January expense and the wages payable that happened in December, right? Now, the cool thing about it, as you can see, is that we put the wage expense in the proper period. We recognized $300 of wages expense in December, and we recognized $700 of wages expense in January. And that's very important. We have to put the expense in the month that it happened. And we did that, right? In December, we recognized $300 of wage expense. In January, we recognized wages expense of $700. Okay, good. So I'm going to start this thing here. Oh, you know what? Let's do this. I'm going to do quick study 3-15. So I'm right here. Let's do this. There it is. Don't worry about this. I just can't get rid of it. Ours starts here. Quick study 3-15 on page 119. Let's go see what it looks like. Okay, this is at the bottom of the page, of page 119. So A, in accounts receivable. At year end, the L Coal Company has completed services of $19,000 for a client, but the client has not yet been billed for those services. Well, we earned it, so we have to record the revenue, right? So that's what we do. We're going to credit the revenue. Now, we haven't even billed them yet, so we didn't receive any cash. So what we do is we take it to accounts receivable, because now we own the right to receive that money because we earned it. Okay, so debit, accounts receivable, credit, service revenue. Now on the top of page 120, B, we're talking about interest receivable. At year end, the company has earned, but not yet recorded, $390 of interest earned from its investments in government bonds. Okay, we earned interest, right? So we've got to record it because we earned it. So we're going to credit our interest revenue. And we haven't received it, right? It hasn't even been even recorded. Now we're going to record it, but we haven't received the money. So we're going to debit the receivable. So in B, debit interest receivable $390 and credit interest revenue $390. The last one is C. This is accounts receivable. A painting company bills customers when jobs are complete. The work for one job is now complete. Well, you finish the job, so you can record the revenue. But the customer has not yet been billed for the work. Okay, so we finished the job, we earned it. So we're going to record service revenue as a credit, 1,300. But yet we haven't received the cash, so it's going to go to accounts receivable. So for C, debit accounts receivable, 1,300, and credit service revenue, 1,300. Okay, pretty easy. I like these because it's pretty easy. Let's go ahead and do 3-13 on page 119. Okay, so A is dealing with salaries payable. Okay, so if you read on page 119, quick study 3-13, at year end, salaries expense of 15,500 has been incurred, which means it happened by the company, but it has not yet paid to employees. Okay, so the expense happened, so we record it, debit salaries expense 15,500, but yet we haven't paid them yet, so now we owe it to them. So we're going to credit salaries payable by 15,500. So again, debit salaries expense 15,500, credit salaries payable 15,500. The next one is interest payable. At December 31, this is the year end, the company owes 250 of interest on a loan. That interest will not be paid until sometime in January. Okay, it doesn't matter that we're going to pay it in January. As of December, that interest was incurred. That interest expense was incurred. So we have to record it, right? So here we're going to debit interest expense 250 and credit interest payable 250. Okay. Last one. Interest payable again. At its December 31 year end, the company holds a mortgage payable that is incurred 875 in annual interest that is neither recorded nor paid. Okay. The company intends to pay the interest in January 7 of next year. It doesn't matter that they're going to pay it next year. The thing is, we incurred it at December 31, so we have to record it. So what we're going to do is debit our interest expense for 875. And remember, we incurred the expense, but we haven't paid it yet. So we have to show that we owe the interest. So credit interest payable, 875. Again, interest expense, 875. That's a debit. And then our credit is to interest payable, 875. Okay. That's pretty easy. Isn't that nice? I like that when it's easy. Let's go ahead and I'm going to go back to our PowerPoint. I'm going to do exercise 3-7 on page 125. And I'm doing it through PowerPoint. And it's really nice because this is kind of a complex problem, a lot of information. It's hard to wrap your mind around it. So I think that the visuals here really help. So anyway, if you want to, you can take a look at it. It's exercise 3-7 on page 125. Here it is. Pablo Management has 5 employees and each earns 250 per day. Now, what you have to remember is that payday is on Friday for the work that's completed Monday through Friday of the same week. Okay. Near the end, 5 employees worked Monday, December 31, Wednesday, Thursday, Friday, which is January 2nd, 3rd, and 4th. New Year's Day, January 1, was an unpaid holiday. Now, Man, couldn't the author give you a break? I mean, that's all for you guys starting out. That's a lot of information. Let me just walk you through this. I think you can kind of see it once you look at the graphs. Okay, well, the first requirement is we need to prepare the year-ending adjustment for wage expense. That means that the wage expense as of December 31. Okay, so we've got to find this number. Well, how do we do that? Well, let's take a look at the calendar. Okay, now we know that on Friday, that's payday, that all of this, like Monday, Tuesday, Wednesday, Thursday, and Friday, it's all paid for. So we don't have to do anything. The expense is paid for. But on the 31st, we did have employees work for one day. Now, there are 5 employees who each earn $250. So if you multiply 5 times 250, right? 5 employees at $250 each, we're going to incur expense of $1,250 on December 31. So there it is. Okay. You know what? I'm going to switch settings so you can see it better. That better? Yeah, that's probably easier to see. Okay. And then, of course, we incurred it, the expense, but we haven't paid it yet. So we have to do wages payable. Okay. Now, B, prepare the journal entry that we be made to record the payment of the employee's wages on Friday, January 4th. Oh boy. Okay, here we go. So we got to find the wage expense on January 4th. Well, to figure that out, let's take a look at our calendar. Okay. This is crazy. Now, this Monday is already taken care of, right? The first day in January is Tuesday, but that's a holiday. So they have off. Isn't that crazy that they would do this to us? We're beginning and they're just socking it to us. Okay, but we do work. We have employees that do work for us for 3 days, right? Wednesday, Thursday, and Friday. And again, if you multiply, we're earning those 5 employees earn $1,250 a day, and there's 3 days. So that's going to be wage expense in January of $3,750. Okay. Now we're going to be paying payday on Friday, right? Because we're supposed to pay on Friday. So what we're going to do, though, is we're going to recognize we're going to have to pay not only this wage expense, right, in January, we have to pay from what we had before, which would be the $1,250, right? And so how much cash on payday on Friday do we need to pay? Well, the wage expense of January, these 3 days, and then what we owed from before in December. That's $5,000. So debit wage expense, $3,750. Credit, debit. Oh no, I'm sorry. Debit wages payable, $1,250, and then credit cash, $5,000. Okay. This is a compound entry. I'd say that this is a little harder for you to wrap around. You might have to study this. Again, my PowerPoint is available to you by itself. So if you want to stop the video and look at it, you can, or you can go right to my PowerPoint and you can go through this again if you wanted to study this. Okay. Now, I do want to help you out because your homework is you're going to be doing exercise 3-15 on page 127. And I just want to give you the answer to A, the very first one. Okay, so what they're going to do, you can read all about it, but basically they're giving you the unadjusted numbers, right? And then they're giving you the adjusted numbers. And for each letter, you have to connect, well, why would that happen? Why would you have service revenue of 18,000, and then after the adjusting journal entry, you would have 25,000? Well, just remember, when you do adjustments, there's no cash being traded, right? So like when it says the hint for A, this refers to revenue that has been earned but not yet billed. No adjusting entries involve cash. So service revenue went up by $7,000, right? It went from 18,000 to 25,000. Now, what would be the adjusting journal entry that would cause that? Well, it'd be this: accounts receivable debit, 7,000, credit service revenue, 7,000. Okay. And I gave you that one. And the other ones, I think from now on, you can kind of figure it out. So, okay. I think that's going to be it. We're going to end the show here. And I'm going to stop the share. All right, guys, that does it for me for the accruals. Look for the next one, the video. It should be on, let me see, look it up here. This is video 6 is going to be on preparing financial statements from the trial balance. That'll be interesting. Until then, study hard. Talk to you soon.